37% gone in a single trading day. No headlines, no emergency announcement, no breaking alert scrolling across the screen. That wasn't a normal sell-off. That wasn't panic. That was a clean, controlled execution. Silver was trading near $121 early Friday morning. By the end of the session, it was hovering around $75. $46 erased in roughly 6 hours. Gold didn't escape either. It fell from $5,600 to about $4,700. Nearly $900 wiped out just as fast. And here's what makes this impossible to ignore. No war broke out that day. No new virus emerged. No major bank failed. No geopolitical shock hit the wires. There was nothing. Silence. Yet we just witnessed one of the largest single-day collapses in precious metals in years. And almost no one can explain why. I can. And once you see what actually happened, you'll understand why this keeps repeating. Why it happened in 1980, why it happened again in 2011, and why it just happened now. 3 times in half a century. Same setup, same mechanism, same outcome. This isn't speculation, it's documented history. I can. And once you see what actually happened, you'll understand why this keeps repeating. Why it happened in 1980, why it happened again in 2011, and why it just happened now. 3 times in half a century. Same setup, same mechanism, same outcome. This isn't speculation, it's documented history. Welcome to the Market Cortex. If you're new here, this channel exists to explain what's really happening in markets while most people are distracted by headlines and surface-level narratives. Subscribe now, because this type of breakdown isn't offered anywhere else. And if this video helps you understand what you just witnessed, hit the like button. It pushes this analysis to people who need to see it. Now let's rewind. Saturday morning, January 31st, final trading day of January, end of the week. Silver is sitting near $120. January had been historic. The strongest month for silver in decades. Roughly 65% gains in just 30 days. Optimism was everywhere. Analysts were talking about $200, even $300 silver. Social media was euphoric. People were convinced they caught the perfect entry. Then 9:30 a.m. hits. New York opens. Within seconds, a flood of sell orders hits the market. Not small orders, not retail profit taking. This was institutional size. Enormous blocks hitting all at once. Millions of ounces dumped simultaneously. That level of coordination doesn't happen by chance. Silver drops from 121 to 115, then 110. Moments later, it slices through $100, the level everyone swore would never break. Support that was supposed to be unbreakable vanished in minutes. And it didn't stop there. 95, 90, 85, 80. Stop losses detonated everywhere. Margin calls flooded trading accounts across the country. Positions were liquidated automatically. Traders weren't choosing to sell. The system was selling for them. By the closing bell, silver sat near $75. Gold around $4,700. 6 hours, 37%. Hundreds of billions in value erased. I watched it unfold live. Years of gains disappeared in real time, and everyone asked the same question. What changed? The official answer? Nothing. They called it a correction, a healthy pullback. Markets getting ahead of themselves. That's the story you were given. Here's what actually happened. Look back at the 60 days leading into Friday. December 12th, silver surges and grabs headlines. Quietly, the CME group, which controls silver futures trading, raises margin requirements by 10%. Barely mentioned anywhere. December 29th, silver keeps climbing. No slowdown. The CME raises margins again, this time aggressively. A 25% increase overnight, no warning. December 30th, less than 24 hours later, margins are raised again, 2 hikes in 2 days. That almost never happens. January 28th, 3 days before the crash, they do it again. But this time, they overhaul the system entirely. Margins move from fixed dollar amounts to percentage-based requirements. 9% becomes 11%. Riskier accounts jump to over 12%, 4 margin hikes in 6 weeks. Roughly an 80% total increase. Now here's what that really means. Margin is the cash collateral required to hold a futures position. You don't pay full price, you post a fraction. That's leverage. When margin requirements rise, every trader must add more cash immediately, not next week. Not when it's convenient. Right now, fail to deposit the money and your position is liquidated automatically. No debate, no appeal. Imagine your landlord calls and says your rent just went up 80% and you have until tonight to pay or you're out. That's exactly what happened to silver traders. Most people don't have that kind of cash sitting idle. They couldn't meet the demand, so positions were sold forcefully. When thousands of leveraged traders are liquidated at once, price doesn't drift lower, it collapses. This wasn't price discovery, it wasn't a bubble bursting naturally. It wasn't profit taking, it was a trigger pull. And here's the part that should unsettle you. This exact trigger has been pulled before. 1980, silver runs from $6 to $50, over 800% gains. Regular people start making real money. The response? The CME introduces Silver Rule 7. Leverage buying is effectively banned overnight. Cash only. At the same time, the Federal Reserve hikes rates from 11% to 20%. Silver collapses from $50 to $10, an 80% wipeout. Game over. 2011. Silver runs from $8 to $50, over 600%. Retail piles in. Banks with massive short positions are under pressure. The response? The CME raises margins 5 times in 9 days, an 84% increase. Silver crashes from $50 to $26. It takes 13 years to recover. Now, 2026. Silver runs from $26 to $121, the largest rally in modern history. The response? 4 margin hikes in 6 weeks. Result? A 37% collapse in 1 day. The fastest destruction of all 3 cycles. Same playbook, same outcome. Once is chance, twice is coincidence, 3 times is a pattern. So why? Well, why does silver trigger this response every time? Because silver isn't the threat. What silver represents is the dollar. The United States' true superpower isn't military force, it's the global reserve currency. Every nation needs dollars to trade, buy oil, and hold reserves. That's why America can print endlessly and survive. But that foundation is cracking. Central banks bought 800 tons of gold last year, not dollars, not treasuries. In January alone, $48 billion in U.S. treasuries were sold. The dollar's share of global reserves has fallen to 58%, the lowest since 1995. For the first time ever, gold now outweighs U.S. treasuries and central bank reserves. That's not symbolic, that's structural. And who's leading the shift? China, Russia, India, Brazil, South Africa, the BRICS nations. They're bypassing the dollar entirely. China alone controls the majority of global silver refining. It controls rare earths, gallium, cobalt, lithium. And on January 1st, silver was officially classified by China as a strategic national resource. Exports restricted. 2 visions collide. One wants physical assets to matter, the other needs paper confidence to survive. So silver gets crushed. Meanwhile, physical demand never slowed. Before Friday's crash, mints were already struggling. The Perth Mint suspended wholesale orders. The U.S. Mint halted Silver Eagle sales. Even at $121, you couldn't easily buy physical metal. Now silver's $75 on paper. Try buying it. Check premiums. Check availability. Paper silver and physical silver are not the same market. Paper can be created instantly. Paper can be crushed instantly. Physical silver cannot. While paper markets collapsed, Shanghai vaults drained 27 tons of silver, removed for delivery. America sold promises. China took metal. That's the difference. And nothing changed fundamentally. Silver has been in a supply deficit for 5 consecutive years. Over 800 million ounces missing. Industrial demand is accelerating. Supply is constrained. Mines take years to develop. The crash didn't change reality. It changed a number on a screen. And that's the key takeaway. They can crush paper prices. They can't crush physical truth. Silver recovered after 1980, after 2011. And it will recover again. Timing is uncertain. Volatility is guaranteed. But the pattern is clear. Friday wasn't a crash. It was a message, a demonstration of control, and confirmation that silver still matters. That's the hidden economy.